In this video, I'm going to take you from A to Z on how to start swing trading and succeed with it. I'm going to take you from the absolute basics to showing you on the chart my strategy, how I trade, so you can do the same. Now, this video is a bit of a long one, but I promise you, if you actually sit through it, then actually put it into action, there's no reason why you can't make 2026 the year that you become consistently profitable. Not going to waste any time. Let's dive straight in. Okay, so firstly, let's start off with what is swing trading. Now, a lot of you will be familiar with day trading, and the difference is when we are day trading, we're mainly looking at the lower time frame and taking trades on a lower time frame, like 5 minute, even 1 minute, etc. Whereas when we are swing trading, we're mainly operating, analyzing, and we're actually entering our trades on like the daily time frame. We also use the weekly time frame, and the actual duration of how long we will be holding these trades is much more than day trading. Day trading, you're in and out during the day. Swing trading, you can hold for multiple days, or in some cases, even weeks. So why swing trading? What's the point of it? Like, why would you even learn it? So firstly, if you are just getting into trading, it is much more flexible and you can fit it into your life. A lot of you guys will be working like 9 to 5s, or, you're busy during the day and you can't just be locked in on the charts. Now, with swing trading, you can just do one analysis a week, go through all of the potential markets that you're looking at, add it to your watch list, and then set a limit order, which we go into if you don't know what that is, but essentially just like a pending order. So it's automatic. You'll get put into the trade and you go about with your life. So yeah. Now also the main reason that I wanted to get involved with swing trading is because I saw a lot of success with swing trading in many different markets. Now, a lot of day trading strategies, from my personal experience, you can trade them on different markets. However, usually one strategy will have a better success rate in a specific market than the other, etc. Whereas with swing trading, you can literally trade pretty much all assets. So it opens yourself up to a lot more opportunity. In terms of the different markets that you can be trading with this strategy, I like to focus on the equity indices. So mainly the US market, being like NASDAQ, US 30, etc., ES, so S&P 500. I also like to look at DAX, which is the top 30 companies, or now 40, got updated in Germany, which is also an index. Of course, the currency, and then the cross pairs, which we'll go into, and then the metals and commodities, and also sometimes I'll be taking trades on like oil, etc. This also does work on like the energies. Now, as I know a lot of you will be trading with prop firms, something that you do need to consider is many prop firms do not allow swing trading, or they try to restrict it. For an example, FTMO just got rid of their 200K accounts and limited it to 100K, and many other prop firms just try to restrict it. So yeah, you need to make sure that you're trading with a prop firm which allows it, doesn't have any weird hidden rules or anything like that. So really go through their FAQs. Another thing that you need to consider is their swap fees. So because we are going to be holding during market close, whether it's overnight or over the weekend, what that means is that we will have to we get a swap fee, which is essentially a commission for holding overnight. And depending on the firm that you're trading with, it can be an absolute piss take. Like, you'd be surprised, even big firms like FTMO, for an example, I'll put a screenshot on the screen. But yeah, like, they will charge you, if you hold for a few days, like $500 in swap fees, which is like a decent amount of your profit. So it's something that you really, really need to consider. Now, me personally, one of my favorite firms to be swing trading with is the Trading Pit. Really, really fair conditions, really, really good rules. They don't limit you on the challenge or the funded phase, and their swap fees aren't ridiculous. So yeah. So timeframes. Now, the two timeframes that we really want to be focusing on is the weekly timeframe and the daily timeframe. Now, the weekly timeframe is used for our overall directional bias, which I'll explain what that means. And then daily timeframe is used for execution, which is essentially just placing your trades. So directional bias is essentially when we go into the weekly time frame and we are looking at, okay, where do we think that the market's projected to go? Where do we think it's going to go in the coming weeks? And then our daily time frame is where we zoom in and then actually find an area that we are going to be placing our trades. So yeah. Now, for those of you who aren't familiar with what a time frame is, if you're like fresh, into trading, essentially a time frame just allows us to see price over a different time period. So right now we can see that we are on the daily time frame, which means that each candle we are seeing right here represents 24 hours, well, 1 day of where price has gone. Okay. And if we go on to the weekly time frame, well, now every single candle represents 1 week. and so on and so forth. We go to the hourly, the 4 hour, the 15 minute, the 1 minute. Hopefully you get the point. So yeah. Now, understanding the anatomy of a candle is really, really important. So we essentially have two things that we are looking at when we are looking at a candle. So firstly, we have the actual candle body, which I'll mark out just like this. Okay, cool. So when we're looking at the candle bodies, which is this right here, excluding the wicks, which is these lines, we are looking at the open and close for this specific time period. So we can see that we're on a daily time frame. So this represents the entire Friday candle. And we can see after Thursday, we opened up down here at this level in price, 24,396. And then when market closed, we closed at this level right here, 24,798. Cool. Now the wicks is representing to us is essentially like footprints. It's telling us where price has been, but it failed to close. So at one point during the day, price came all the way down to here. And at one point during the day, price came all the way up to here. However, it failed to close at this level. So once the 24 hours of this candle was up, price finished here. In the same way that when those 24 hours began, price started here. Okay, cool. Now we have a basic understanding of the time frames. Let's move into how we actually use the weekly time frame and the daily time frame. Now, as I already mentioned, the weekly, essentially, we are using it to project or have an idea of where price could potentially go, and then that will become relevant of when we go into the daily time frame and we actually place the trades. Now, in order to understand where price is going to go, we need to dive into market structure. Okay, so market structure, we have bullish market structure, bearish market structure. Now, bullish simply means that price is going up. Bearish means that price is going down. So how do we identify bullish market structure? Well, let's dive into that first. Now, if I was to ask you this area of price right here, what would you say? Would you say it's either bullish or bearish? Well, it's pretty obvious that it's probably bullish, right? Now, this price action right here, right, what we are seeing on the charts is quite obvious to identify that is going up. However, there will be times, for an example, just over here, well, yes, it is kind of going up, but it's harder to identify. So it's important that we put rules on what bullish market structure is and what bearish market structure is. So when it's not this easy, we're still able to navigate the market. So what is bullish market structure? Well, bullish market structure is when we are seeing higher highs and higher lows. What does that mean? Well, if we take a look at this right here, this would be considered a low. This would also be considered a low. However, this low is higher than this low in the same way that this is a higher low. This is a higher low, so on and so forth. Now with higher highs, it's just the same, but the opposite. So if we look at this is a high. Here we have a higher high. Here we have a higher high. Here we have a higher high. So that to us shows us that we are clearly in a bullish market. Why? Because we are making bullish market structure. So bearish market structure, we identify this by seeing lower highs and lower lows. So for an example here, we can see that we have a low. We then have a lower low, just about close below it. And then we have a lower low here. And here we can see that we have a high, we have a lower high, and we have a lower high. Now, as you can see, price came up a lot. However, this is the important thing, because we did not close above this previous high, that means that we are still in bearish market structure. So this is the rule, okay? As long as price is printing bearish market structure or bullish market structure, we are anticipating that price is going to be continuing to go long, which means go up if we're in bullish market structure, and go short if we're in bearish market structure. Now, let's talk about that a little bit more. Now, let's say you're trading, you're looking at the trend, and then suddenly what has happened is, in this case, it was a bearish market structure, but now price is closed above this previous high. That means that the bearish market structure has been broken. Why? Because now we have closed above this high, so it is impossible for us to have a lower high. And if we don't have a lower high, that is no longer bearish market structure. Cool, so now we have the basics on that. on the weekly time frame, how do we actually identify market structure? Well, obviously, I just told you if we're looking for bearish market structure, we're looking for lower lows and lower highs. And if we're looking for bullish market structure, higher highs, higher lows, right? But sometimes it can be a little bit harder than just looking and identifying it straight away, because sometimes we can be in situations where price is not super clean. So there's a golden rule that essentially you want to follow. So we want to look at the three previous highs and lows. So if we go ahead and mark out the three previous lows, so 1, 2, 3, and now we're going to mark out the three previous highs. Cool. So now we've had them marked out. Now, how you mark them out doesn't really matter. You can circle it, you can put a square box on it, or whatever helps you, essentially. Okay. So now we have these marked out. Okay, we need to ask ourselves the question, is this bullish or bearish market structure? Now, in this case, it's obvious. After this, I'll show you one where this rule will really help you. But here we can see low, higher low, low, lower low, lower low. Then we have high, lower high, lower high. Cool. So obviously, this is bearish. However, if we're trading in conditions like this, suddenly it becomes a little bit harder because it's not just going straight up, right? So what do? Well, we go back and we look at the previous three lows. 1, 2, 3. Cool, so we've now gone ahead and marked them out. So now we need to ask ourselves, cool, is this bullish or bearish market structure? Well, here we have a low, we have a higher low, and we have a higher low. And here we have a high, but is this high higher than this high? Not really. But is this higher than this high? Yes, it is. Cool. So there's going to be many situations where you're looking at the market, right? And for an example, in this case right here, we can see, okay, cool. We have this high, which is actually technically lower than this high. So technically that means that it's not bullish market structure, right? But then what we need to rely on is, for an example, in this case, we have low, higher low, higher low. So overall, the volume, the direction is still going up. So in this case, we can project that price is probably still going to be going up. Okay. Now, let me show you another example that you may face. Okay, so we open up the market and this is what we see. Now, suddenly, this doesn't really look like it's going up or down. Okay, we can see that, okay, let's do the rule. Let's mark out this low. We'll mark out this low. And then the next low that we have to mark out, as you can see, there isn't really any lows here, right? So it's not really making sense. And then we have, well, this hasn't technically formed as a high. But overall, it's just weird. It's just not as simple as what we was doing before, as you can see, right? We haven't got clear bullish or bearish market structure. Now, if you're in this situation, what that means is that you are looking at a consolidation / sideways, essentially. Okay. So this is where we are not making clear bullish or bearish market structure, which essentially leads to us moving sideways. Okay. Now we're going to circle back to this later on. However, it's just important that you understand what that is. I just went ahead and wrote this down. So if you want to take a screenshot or anything, then you can. Okay, so now you have a basic understanding of how we actually identify bullish or bearish market structure, specifically on the weekly time frame, and also how we can identify when we are consolidating, so going sideways. Now, one thing that we do need to touch on, which we briefly went over, is when we are looking to take an anticipatory trade or when we are breaking out. Okay, simply put, what does that look like? So we can see here that until this point, we was making bearish market structure. As you can see, low, lower low, lower low, lower low. And now we can see what has happened is that we have closed past this previous high. Okay. So what does this mean? It means that we are anticipating that we are about to break out into a bullish trend. Okay. We're breaking out. Okay. Now, this is the thing. When we break out, that is not enough alone for us to conclude that we are now into a bullish trend. Why? Because remember the golden rule. The golden rule is we must see consecutively, if we're going into a bullish market trend, is 3 higher highs and 3 lower lows. Well, here we can see we have neither of those. So this would be anticipating that we are going into a bullish trend. However, we have not yet seen that golden rule for us to fully say, okay, cool, we're in a bullish trend. So right now, this might not mean a lot to you, but it's important information for us to circle back to a little bit later on. So yeah, but as long as you have a basic understanding of this, then we can continue on to the next steps. Now, an example of when we are breaking out or when we are anticipating a new trend is, for an example here, we can see that we have this low, then we have a higher low, and now we can see that we have had a candle close past this previous low. Therefore, what that means is we have broken bearish market structure. Why? Because it's now impossible for us to have a higher low. And if we don't have a higher low, we've now broken bullish market structure and could potentially be breaking into bearish market structure. So yeah, if this is a little confusing to you, just go to the chart and just take a look at try and identify a few different examples. The easiest way is just to open up a random point in your chart. For an example, just like this. If we were to go like this, we can see, cool, to this point, looks like we are making bullish market structure. We have now had this candle close below this previous low, which means that we could potentially be breaking out into bearish market structure. However, it's very important that we understand this alone is not enough to suggest that we are now in a bearish trend, because we can see in this case right here, we came all the way back up. Okay, so once you've done your overall analysis on the weekly time frame, you then have your overall bias. And from that, you should decide of what state the market is currently in. Are we bullish? Are we bearish? Are we consolidating, so going sideways, or are we breaking out, so anticipating a new trend? So yeah. Now, very simple. If we are bullish, we're going to look to buy. If we are bearish, we're going to be looking to sell. Now, if we're in a consolidation, we can actually buy or sell, but it comes from discretion, which I'll touch on what that is. And the same with anticipatory trades and breakouts is also very discretionary. So yeah, so these are the easiest to follow along with. So we'll go through these first, and then we'll come back and touch on this. Okay, so before we go any further, we need to understand what is supply and demand. Some people call this support and resistance. Some people call this order blocks. I learned it as supply and demand, so that's what it is, and it works. So yeah, doesn't really matter what you call it, just matters that you understand how to identify it. So what is supply and demand? Well, supply and demand in trading specifically, right, is how we are able to identify where the big money, so banks and institutions, have previously bought or sold at. Okay, we'll understand why that's really important in just a second, but just take a look at an example like this. Okay, so we can see that this representing price is coming all the way down here, and out of nowhere, it just turns around and goes all the way up here. And then when it comes all the way up here, it stops and goes all the way down here. Now, only big money can move the market like this, which means when we see a move like this to the downside, or we see a move like this to the upside, we can assume that a bank has sold here and has bought here. Okay, now this is an example that you can see right here. We can see it was moving up out of nowhere, big dump, right? Big dump. And then we can see suddenly out of nowhere, we just turn around and move all the way higher. And then we can see that we tap back into where a bank or an institution has previously sold at. And we can see that once again, we move down lower. So why does this happen? This is what we need to focus on. Why does this happen right here? Okay, this is what we're interested in. This is how we catch our trades. So a bank or an institution, okay, I'm going to make this as simple explanation as possible. I don't want to make it too long, but a bank or an institution, okay, cannot enter all of their positions at once, right? You have to imagine that when they are buying here, right, okay, they are entering with billions and billions and billions and billions of dollars. Now, in order for them to enter at this specific level in price, what that means is that there needs to be willing sellers at this level. That's how the market works, right? In order to buy, there need to be willing sellers at this exact level. So in order for them to get filled, in other words, in order for them to get all of their orders into the market, they would have to find, let's say, for an example, 4 billion sellers at this specific level in price, which is pretty much impossible, right? So what do? Now, let's say they want to enter with a total of 4 billion orders at this specific level in price. Or let's say they enter with 1 billion here. Now, because $1 billion just entered the market, that caused the market to spike. Then they wait patiently and they wait for price to come and tap back in here again to enter another $1 billion of orders. And then as we can see, price reacts, okay? And they just keep on doing this until all of their orders have been filled. So what you are seeing, right, when we are looking at this is we were seeing bank buy here, bank buy here, bank sell here, bank sell here, right? And then eventually what will happen is, as we can see here, price went higher because all of their orders have been filled. So just for an example, let's say they wanted to enter a total of 2 billion orders. They enter 1 billion here. They enter 1 billion here. Next time price comes up, there's no resting orders here. So therefore, price continues to rally. So yeah. And one thing you have to remember is that we're on the higher time frame, right? We're looking at daily or the weekly time frame. So all of these moves are much more significant. If we were to see the same pattern on the 1 minute time frame, well, it's really not as significant, right? Because the amount of money we are looking at, the amount of volume we are looking at with these moves right here is billions and billions and billions of dollars. Whereas on the 1 minute time frame, we're only looking at 1 minute in price, and behind that move, there is not going to be billions and billions of dollars. So yeah. So our job is very simple. We need to learn how to identify these areas where a bank has previously bought or sold at. So next time price comes back up to this level and more of their orders are filled, we can catch the wave, as you can see here and here. Okay, so you can go ahead and take a screenshot of this, but supply level simply means area where banks sold. Demand level simply means area where banks bought. What that also means is we look to take sells from supply levels and we look to take buys from demand levels. Okay, so now moving over to the daily time frame. If on the weekly we are making bullish market structure, we're going to be looking for buys, which means we look for areas of demand on the daily time frame. And if the weekly market structure is bearish, then we're going to be looking for sells, which means we're going to look for areas of supply. Now, before we can actually go ahead and start looking at these areas of supply or demand, we first need to understand the difference between an impulsive and an indecisive candle. So the main difference between a impulsive and an indecisive candle is not the size, right? It does not need to be a huge candle to be an impulsive candle. What makes it an impulsive candle is a small wick to body ratio. So for this example, you can see right here, right? If we look at the wicks in comparison to the body, they are very, very small. If we look at this example right here, an indecisive candle, we can see that has very big wicks in comparison to the body. Okay. Now, one shows strong volume, strong direction, okay, within the market. Another shows, well, indecision. It shows kind of weak volume. The market doesn't really know where it wants to go right now. So yeah. Now, if we go ahead and take a look at this, what would you say that this candle is right here? It's an indecisive candle, right? Why? Because the wick is significantly bigger in comparison to the body. If we take a look at this candle right here, this would be an impulsive candle, right? Because we can see that the body in comparison to the wicks is much bigger. Okay. This one right here, indecisive. These ones right here, very indecisive. This one, still indecisive. This one, impulsive, right? And some of them will be really obvious. Like, for an example, this candle right here. we can say, well, this is obviously impulsive. Why? Because the wicks are tiny in comparison to the body. For this one, for an example right here, we can see, well, the wick is fairly big. However, in comparison to the body, it's still a very impulsive candle. Okay. So yeah. Okay, so the reason that it's important that you are able to identify the difference between a impulsive and an indecisive candle is because within every single supply and demand formation, no matter whether it's demand, no matter whether it's supply, whatever formation it is, we essentially identify it by looking at impulsive and indecisive candles. Okay, so for an example, as you can see here, the supply formations. Okay, we'll run through how to actually identify them, but just for the sake of actually showing you, we can see here we have an impulsive candle on the way in, not super impulsive, right? But in comparison to the body, once again, the body is bigger. Then at the top, we have an indecisive candle followed by an impulsive candle out. Once again, here, another supply formation. Impulsive candle followed by indecisive candle followed by impulsive candle. Down here, demand. Impulsive candle in. Indecisive candle, impulsive candle out. Here, impulsive candle in, indecisive candles, and then impulsive candle out, right? So although these different formations might look slightly different, the anatomy of them is literally all the same. Okay, and we can break that down into three parts. So we have a leg in, which is going to be an impulsive candle. We then have the base, which is going to be indecisive candle or candles. Okay, so it can be multiple. In this case right here, we have two. In this case right here, we have one. And then followed by a leg out, right, which is also going to be impulsive, right? So with that bearing in mind, what we can see is that we have here, this would be our leg in, followed by our base because it's indecisive, followed by this, the leg out, because it's impulsive. Here we have a leg in, base, leg out. Leg in, base, leg out. Leg in, base, leg out. Okay? So as long as you are able to identify indecisive and impulsive candles, then you're not going to have any problem with identifying supply and demand candle formations. And I'm going to show you exactly the process to do that now. Okay, so let's take a look at this example right here. Now, this would be a demand formation, right? Because we can see that price was moving down and out of nowhere. Clearly, a bank or an institution has entered the market here, which pushes the market higher, which means next time that price comes down to this level, we are going to be looking to take buys. Now, where is the leg in? The leg in is going to be this candle right here. Where is the base? The base is going to be this candle right here. Where is the leg out? It's going to be this candle right here. Okay, so we're looking at another example now. Wonder if you can identify it or not, but it's this right here. Okay, we can see huge move to the downside is on a daily time frame, remember, so this is billions and billions of dollars worth of selling happening. Out of nowhere, just stops, moves higher. So we can assume that a bank or an institution has definitely entered the market here. The only entity that can move the market in this kind of way is going to be banks and institutions. So yeah. And once again, what do we have? We have a leg in, the base, leg out. Let's look at another example. Where do you think it is? It's here. Now this one's slightly different because the other ones, the base has been just one singular candle, but it's very important that you don't fixate on it being one singular candle, okay? The base is us isolating the indecisive candles, okay? Plural S. So it can be multiples, right? It can be multiple candles. So for an example, once again, what do we have here? We have leg in impulsive. And this is all the base. This is all the base, okay? Indecisive, 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 pretty indecisive still here, right? Look at the wick compared to the body. And then huge move down, okay? So we'll go through how to actually isolate the base, but just for this example, this right here is our base. Okay. Now we can see that price actually came in, tapped in, and absolutely melted. So this within itself is kind of a lesson right here. These levels that you are finding, they don't have an expiry date because we are operating, well, our theology is based off banks and institutions sold here. Next time it comes up, they sell again. They are very, very patient. They will wait years and years for their orders to get filled. And in this case, we can see that they waited pretty much a full year and then it absolutely melted. So yeah, but once again, right, impulsive, leg in, base, in this case, multiple indecisive candles followed by leg out. Okay, so what's the step-by-step process into identifying demand? Well, let's go through it. So step one, look down to the left. Now we want to keep on going until we find an impulsive candle. Is this an impulsive candle? No, it's not. Any of these impulsive candles? No, it's not. Is this an impulsive candle? Yes, it is. Step one. Step two, we're going to look to the left of this impulsive candle and find an indecisive candle or candles. So, impulsive candle, look down to the left. Indecisive candle, that's step two, complete. What's step three? Step three, we're going to look above to the left to see if we can find an impulsive candle. All right, so we found this indecisive candle. Let's look above to the left. Do we have an impulsive candle here? Yes, we do. And there we go. We have now just identified an area of demand. And in doing so, we identified our leg out, our base, and our leg in. So this demand formation that we have just identified is called a drop base rally. It's called many other things as well, but for simplicity's sake, it's a drop base rally. Why? Because we see price drop, we then see a base, and then we see a rally. Okay. And just to really show you what is actually going on here, right? The story behind the candles. We can see that until this point, price is extremely bearish, right? We're looking at billions and billions and billions of dollars of selling happening before our eyes. Out of nowhere, price stops, right? So just in order for price to stop, a large amount of buy orders must have come into the market to essentially stop it. From there, we can see that price then goes much higher. So we see this leg out, right? And the only way that this can be caused is if a banking institution enters buy orders right here. So that's just kind of the, I guess, theology or the thought process behind what we are actually trading. So yeah, cool. Let's go over to another demand formation. Now we're looking at another demand formation. Although it's a different formation, the steps in identifying it are the exact same. So we're going to look down to the left. Right here, we can see that we have an impulsive candle straight away. So we've identified our leg out, step one. At the bottom of this impulsive candle, this leg out, we're going to look for indecisive candles. And we have them right here. That's step two. We've identified our base. Now, instead of looking above to the left, we are going to be looking below to the left to see that impulsive candle, which is going to be our leg in. So once again, leg in, indecisive candles, leg out. So although it's a slightly different formation, the strategy or the steps to actually identifying it are the exact same. Okay, moving on to another supply formation. This is the final formation from demand and supply. And once again, the steps to be able to identify it's going to be the exact same. What we're going to do, we're going to look up to the left until we find an impulsive candle. Here we found an impulsive candle. Step one, complete. Just identified the leg out. Now we're going to look to the left. Do we see indecisive candle or candles? Yes, we do. Cool. Step two, complete. Just identified the base. Step three, above. Do we have another impulsive candle? Yes, we do. So what have we done? We have now identified an area of supply. So yeah. And here you go. If you want to take a screenshot, this is a drop, base, drop. Why? Because obviously there's a drop, then there's a base, and then there's a drop. Now, I'm sure some of you have been wondering, why am I drawing around this and why am I putting lines, etc.? Or how do you actually do it? So when we are trading off the base, meaning that we are waiting for price to come back into this level in order to take a trade, as I showed you earlier when we was talking about the basics of supply and demand. Now, in order to actually isolate our base, right, we are going to do the following. So option number one, what we're going to do is we're going to mark out the lowest wick to the highest wick, just like that. Okay, really, really simple. And then, to be honest with you, you don't need to do this, but I just like to draw so I just know exactly what I'm isolating. So I know that from here to here, this is what I am really considering the base. It's these indecisive candles, right? The leg in is not part of the base. The leg out is not part of the base. The base is the indecisive candles, okay? And that's why we are marking it out from the indecisive candles. So yeah. Now the same would apply to this demand formation, which seems to be appearing right here. So let's go ahead and mark out the lowest wick to the highest wick. Cool, we have now just isolated our base. And here we have our area of demand. So next time price comes into this level, potentially we would look to take a buy. Of course, we need to look at the weekly, etc. But I'm just showing you as an example right here. And this rule is the same whether we're looking at demand, whether we're looking at supply. It's going to be the highest to the lowest wick. Okay, that is option number one. Now let's look for possibly an area of supply, for an example. Cool, so here we can see we have a leg out, base, indecisive candles, leg in, impulsive. Cool, so we have an area of supply right here. So we're going to go ahead and mark out the lowest wick to the highest wick, okay? And we are isolating these candles. This is what we're focused on, right? If you want to, you can even, just isolate it by drawing a box around it, put lines in between it, whatever you need to do to just make sure that this is what you're focused on, right? The base is the indecisive candles. So yeah, there we go. Cool. So now we have our area of supply. Okay, let's look for another example. So in this case, we're going to be looking for demand. What do? We look down to the left to find an impulsive candle. Here we found an impulsive candle. At the bottom of it, do we have an indecisive candle? No, we don't. So we have to keep on going down further. Here we see an impulsive candle. To the left of it, do we have indecisive candles? Yes, we do. To the left of that, do we have an impulsive candle? Yes, we do. Cool. So we just identified an area of demand. Now, in order for me to mark out my base, I'm going to mark out the lowest wick to the highest wick within the base, within these indecisive candles, okay? Once again, that is what the base is. Okay, so now we went over how to actually identify the base and isolate it. Now we're going to move over to the preferred version. So what is the preferred version? It's really, really simple. For the preferred, when we're looking at demand, instead of marking out from wick to wick, being the lowest wick to the highest wick, we are still marking out the lowest wick. However, we are going to be marking out the top line, this one right here, from the highest body. Now, I'll say this one time. The bottom line, when we are marking out demand, is non-negotiable. We are always going to be marking out the lowest wick. Now, moving over to supply, the preferred version, once again, so it's just flipped. The bottom line becomes the top line, and we are going to be marking out the highest point that price reached, to the highest wick, okay, within the base, within the indecisive candles. But instead, we are going to be marking out the lowest candle body, okay? Really, really simple. You can go ahead and take a screenshot of this. So yeah. So why do we use the preferred? Why is it even a thing? So using the preferred allows us to get more risk to reward. However, the downside with that is that there is a lower chance of us getting filled. So actually entered into the trade. Now I'll go ahead and show you an example. So with this right here, if we go ahead and mark out this position, if we are working with the preferred, then all the way down to this demand, so targeting this demand, we would get a 1 to 3.37. However, if we are working with the wider, then we would instead get a 2R essentially. Okay. So what we're doing by using the preferred is we are increasing the amount of money that we would be making. We're increasing our RR, risk to reward. However, there is a lower chance that we will get filled because if we take a look right here, let's say price comes up. Let's say price comes up like this and then taps into our wider and then moves away from here. Well, then we've not entered the trade. Okay, so we're just missing out. However, if price does come up to the preferred, as I said, we would get a larger RR. So there's different use cases for it. For an example, with this demand right here, if we mark out the wider, so from wick to wick, we can see that the RR that we would be getting is not significantly more, right? If we go ahead and mark this out, we get around 4R, meaning that if we put $1,000 in, if this hits full take profit, we would get $4,000. Now, if we go ahead and mark it out based off the preferred, we would be getting an extra 0.5 RR. So we make $4,500. Now, in this case, does it make sense to use the preferred? Well, not really, because we're not getting a huge amount of RR. So let's not be greedy and just increase our chances that we might get filled into the trade. Now, when you would not use the wider is a situation like this. So let's imagine that this wick is this big, which means that our wider would be this big. Well, in this case, it doesn't really make sense because in order for us to get, a 1 to 2 or a 1 to 3, price has to travel so far, right? And if we was working with the wider, we wouldn't even get a 1 to 2. So in this case, it makes much more sense to be targeting the preferred, and we would get more RR. Okay, so now we need to talk about the importance of explosiveness from your zone, okay? Or the momentum that carries once price has left your zone, okay? This is what validates a zone, and this is what makes a zone not valid, essentially. So as you can see here, we have some examples, then we'll go to the chart. But here we can see that from this area that we have marked out, there is a huge move that has happened, right? Price stopped here and absolutely dumped. Price stopped here and absolutely dumped. Price stopped here and absolutely dumped, as you can see, right? Now, if we take a look at this example over here, yes, price did have a move to the downside, it then stopped. And then it looked like we was going to have a nice impulsive move out. However, what came after was this disgustingness, right? This is not good momentum. This is not what we want to see. Now, why is this important? Well, if we think about what we first spoke about, right? Talking about supply and demand. Now, we are basing the fact that these zones are where institutions has entered the market. And if that's actually the case, well, we can expect a very big move from there. If we don't see a big move from there, then chances are it just looks like a zone, but it's not actually where an institution has entered the market. Because if it was, then we would have seen a huge move just like this. So this is really, really important. I've seen a lot of people make the mistake of thinking that everything's a zone, but no. The best advice I can give you is look for the obvious zones. Okay, look for the zones that aren't hard to find because they shouldn't be hard to find. The zones which work the best are usually the ones which are the easiest to find. Now think about what I just said, obvious zones, right? If we take a look at this chart right now, we can probably identify, well, this is a very obvious area where, price is moving down and out of nowhere, it just exploded. An institution has entered here. Same here, right? We can see the price is moving down out of nowhere, it just exploded. Once again, it's probably an area of demand where an institution has entered buy orders, right? And once again here, this is very, very obvious. As we can see, price was moving up and then it just sold out of nowhere. Once again, most likely where an institution has entered sell orders. Once again, as we can see, huge move to the downside, indecisive candle followed by a huge move to the upside, right? Very, very obvious that, okay, cool, definitely an institution has entered the market here. This is the type of level that we want to avoid. This is not valid. Why? Because we can see that from this area, the move was not significant. There was not a lot of momentum. And if, in fact, an institution did enter the market here with billions and billions of dollars, we would see a much more dramatic move than this. So look for the obvious moves. Okay, so we've gone through quite a lot. Before we move forward, we're just going to have a little recap, go through the technicals that we have learned so far. Now, this is just purely the technicals that we've gone over, not really like me explaining supply and demand, why it works, the reactions, etc. The, I guess, theology behind it. But yeah, just purely technicals, looking at candles, the step by step, essentially. So what's the first thing we do? We start on the weekly time frame and we identify market structure. Are we bullish? Are we bearish? Are we consolidating? Are we breaking out? And depending on that, if we're bullish, we're going to look to buy, which means what? We have to go to the daily time frame and look for areas of demand. If we're bearish, we're going to look to sell, which means we need to go to the daily time frame and look for areas of supply. Now, in terms of identifying the zones, let's start off with supply. As I said, both of them, the exact same steps, just ever so slightly different. So when we're looking for supply, what we're going to do is we're going to look up to the left. We're going to find the impulsive candle, which is what? It's going to be the leg out, always going to be the leg out is what we're going to identify. Now, at the top of that candle to the left, we're going to look for indecisive candle or candles, right? It can be multiple, as we've discussed. That is the base. The indecisive candles is the base. Okay, remember, we're isolating the indecisive candles as the base. The leg out, the leg in, that's different. Cool. Now, once we have identified the base, what we're going to do is we will look up to the left and identify another impulsive candle, which is going to be a leg in for a drop base rally. So we look up, impulsive candle, indecisive candles, up again. Here we have an impulsive candle, sorry. Cool. That right there is one of our supply formations. It's a drop base drop. Cool. Now, if we're going to be looking for the other one, which is a rally base drop, well, in that case, we're just looking up, impulsive candle, up to the left, indecisive candle, look below, impulsive candle. Cool. Now with demand, the exact same thing. So if we're going to be looking for a drop base rally, we're going to look below, find an impulsive candle. Below that, we'll see an indecisive candle. Above to the left, we'll see an impulsive candle. Cool, that's a drop base rally. For a rally base rally, what we're going to do is we're going to look below, find an impulsive candle. Below that to the left, indecisive candle or candles. Below that to the left, impulsive candle. Cool, here we have our rally base rally. Cool. Now marking out the base, which is what we essentially just went over. So for our wider, really, really simple. Okay, we isolate the indecisive candles and then we mark out the highest and the lowest point that price reached within that base, which is being the highest and the lowest wick. Now for the preferred, when we're looking for demand, we are going to move instead of having it at the highest wick, we're going to move it to the highest body. And this is non-negotiable. The bottom line is always going to be the lowest point the price reached, the lowest wick. Cool. Preferred, when we're looking for supply, is the same, just flipped. So we're going to mark out the highest area which price reached within the base, which is going to be the highest candle highest candle wick, sorry, not body. And then for the bottom line, instead of it being the lowest wick, we are instead going to move it to the body, just like so. And then what we just went through is that we must see an explosive move from our area, right? Otherwise, it cannot be seen as a valid area, as the example that I previously showed you. Okay, so now let's do a quick run through of what we have learned so far. So let's start on the weekly time frame. As we can see, we're on a weekly time frame and we're currently looking at USD CHF. Now we can see that on the weekly, we have actually been very, very bearish, which makes sense because usually the Swiss franc in recent times does outperform the dollar. We're going to go into Forex specifically. However, right now, this is just for an example. So yeah, we can see that we're definitely more bearish than bullish. I mean, if we really want to go ahead and mark it out, we can see we have a high here. This becomes a lower high. And this is not really ever so slightly a lower high, right? But we can tell from like this low being lower than this low and this low being lower than this low ever so slightly, that overall it's definitely more bearish market structure, right? So then what we're going to do once we've got our overall bias on the weekly time frame is we're going to go over to the daily time frame. Now, because our overall sentiment or our overall bias, right, from looking at the weekly time frame is bearish market structure, what are we going to look for? Well, we're going to be looking for sells, and because of that, we're going to be looking for areas of supply, right? So now we zoom in, on the daily time frame, and now we need to look for an area of supply. So what's the steps of doing that? Well, we're going to go above. Do we see an impulsive candle? This is not really super impulsive, to be honest with you. We could argue, well, the wick to body ratio, the wicks are still smaller than in comparison to the body, but it's not super impulsive. And especially with the leg out, we need to be very, very strict, which we'll get into the specific rules and parameters after this. So yeah, now we go above. Do we see impulsive? No, we don't. This isn't really impulsive either. This is not impulsive. This is not impulsive. Okay, cool. Here we have an impulsive candle. Why is it impulsive candle? It's not because it's a big candle, because if anything, this one isn't, it's not a super big candle, right? It's an impulsive candle because the wick to body ratio, right? The wicks in comparison to the body are small, right? So it shows a clear direction. It shows clear volume. Cool. What's the next thing? So we've now just identified our leg out. We go above to the left and look for an indecisive candle. Here we have an indecisive candle, clear as day. This is an indecisive candle because the wicks are much bigger than the body. Cool. Now we just go along to the left. Do we have an impulsive candle? This one, it is definitely it is definitely impulsive. However, it's not the most impulsive, but the leg in, we can have some wiggle room. Once again, we'll get into the rules and parameters after, but for me personally, this is enough of an acceptable leg in. Great. So now what do we do? Well, we're going to go ahead and mark out our area of supply. So we can start off by marking out the top line, which is non-negotiable, always going to be the highest area within the base. What is the base made up of? The indecisive candle at the top, right? In this case, there can be indecisive candles, multiple. We go ahead and mark that out. And then we're going to go ahead and mark out the lowest wick. So remember, what is this? This is the wider version, right? If we want to use the preferred version, well, we're going to mark out the body. Cool. Now, in this case right here, we can see that the price has to travel very, very far in order to tap us into our preferred, right? If we look here, we can see that price needs to travel very, very far in order to tap us in to our preferred. Now, in this case, it probably makes sense to use the wider because price has to travel so far. And once price has extended itself, usually what comes is a slight retracement. It makes more sense for us to target the wider. Yes, if we was to target the preferred, we would definitely get more RR. However, in this case, even when we are targeting the wider, we are still getting a nice healthy RR, right? There's no point in being super greedy. So let's go ahead and take a look. If we were to target the preferred, yes, we would get, a 1 to 5. But in this case, let's go with the wider just purely because of the amount of area that price needs to cover to get into this zone. There is a chance that perhaps it will come into the wider and then just move down lower. So let's go ahead and play this out and see what happens. Okay, we can see that we have now tapped into our wider, starting to reject a little bit here. Looks like we come and tap again, and then eventually it plays out. Cool. So in this case, let's have a look. Maybe we would have got tapped in on the preferred. It looks like we might have just got tapped in on the preferred. And in this case, if we did get tapped in, that would have been an absolutely beautiful entry. As you can see, we would have secured like a 1 to 8 there, But in this case, for me specifically, I would prefer targeting the wider just because based off experience, a lot of the time, what can happen is price will tap in to the wider, you're targeting the preferred, and then it just leaves without you. So yeah, it's better to be in the trade and make money instead of just like getting edged and it playing out right in front of you. So yeah, that is essentially a little breakdown of what we have gone through so far. Hopefully, you're following along. If not, that's fine. We still have a lot to go over. But yeah, what I really recommend you do at this point is if anything's unclear, rewatch it from now before we go into any more advanced things. Okay, rewatch it from the beginning to here. Take notes, take screenshots, whatever you need to do to make sure you have retained that information. Do that now before we move on to anything else. Okay, now before we go any further, we need to go over some rules. So there are some rules and parameters in place to make sure that you are trading the highest quality sales, the highest quality zones. And we have a few different, I guess, rules you could say, in order to check that our zones are actually valid. So the first one that we need to talk about is whether a zone is still fresh or not. So what does this mean? Essentially, if we think about what we first went over, right? What is supply and demand? Well, supply and demand, the way that we use it is how we identify where a bank or an institution has previously bought or sold at. Now, our whole theology of why these zones work is that banks cannot place all of their orders at once, like we spoke about. There is not enough liquidity in the market. There is not enough, say, for an example, they want to enter buys. There's not enough willing sellers on the other side to match all of their orders at that specific level in price. So instead, what do they need to do? They need to wait over time until price comes back up to that specific level in order to enter more positions, which is what causes reactions like this. Cool. Now, this is relevant because what we can think about is this zone right here, for an example. We know that somewhere within this zone, a bank has placed sell orders. We don't know exactly where. It could be here, it could be here, it could be here, it could be here. Okay. But the further that price travels into the zone and then has a reaction, we can assume that the more orders have been filled. Why is this important? Because let's say, for an example, we can see that price came up to this level, came in quite a decent amount, came in again. We can now assume that, both times there was a reaction, that orders have been filled both times. So what does that mean for when price comes up to this zone the next time? Well, it lowers the chances that price is going to react off it, that price is going to respect it. Why is that? Well, for an example, let's say an institution wanted to enter a total of, let's just say, 3 billion sell orders. So they enter their first billion here. They then wait until price comes back up. They enter their second billion here. Now they enter their final and third billion here. So then what does that mean? Well, next time price comes up to this level, there is no longer any resting sell orders. So price could very well just go through it. Just like this example that I put on the screen right here. We can see that if price just touches it and does not come into the zone, specifically more than 30%, right? Well, that zone is still valid. We can trade it, right? So in this case right here, we can see that it just touched the zone, so therefore it's still valid. It goes up to the supply level, it just about touches the zone, therefore it's still valid. Meaning that when price comes down, well, comes up here, we can take a trade, right? And when price comes back down to this demand level, we can take a trade. Now we can see instead of it just touching it, it has deeply retraced into this level. And the same way that it's deeply retraced into this level right here. Now, as soon as we have seen a deep retracement, more than 30%, what that tells us is that this zone is no longer valid. So at this point, when price came into the level more than 30%, this zone is no longer valid. The same way that up here, this zone would no longer be valid, which means that we are not looking to trade off these zones anymore, right? So we can see here, cool, this is the initial reaction. We waited until price came up. We entered here. And we can see that in this situation, price has definitely come into the zone more than 30%. So that now means for me that I am no longer interested in trading this level because there is a chance that all the orders have been filled. So next time price comes into it, it's not going to have a reaction. Okay. It very well could. Sometimes zones, even though they have been retraced into more than 30%, they will still react. However, it's about making sure that we are working with the highest quality setups. And the highest quality setups is going to be zones which have not been retraced into a decent amount. So we can assume that there is still resting sell orders in this situation. Well, this example right here for when price comes up next time. Okay. So yeah, this is really, really important. And the way that you simply do this is that you're going to go ahead and mark out your zone. So as we can see here, let me just get rid of these drawings. Just go to cool. So let's say we open up the chart just like this. We go ahead and we mark out our zone just like this. Okay. There we go. And now we're just going to look to the right. And as we can see in this case, because this is where price is currently at, this zone is fresh. It has never been tapped into more than 30%. Cool. So we can definitely take a trade off this. Now price is tapped in to this zone more than 30%, which means that, cool, we may be in a trade right here. However, because price is tapped in more than 30%, we will not be looking to trade again when price comes up to this zone. So after this position, this zone right here is no longer valid. However, as we can see, because it's no longer valid, what does that mean? We need to look for a new potential supply level. And we can see that as price was playing out, a new supply level occurred. And we can see, so we can just go ahead and mark that out, right? So although it is overlapping, right, this itself can be treated as a separate supply level. So once this is no longer valid, we can look for a new one. In this case, we found one straight away. Sometimes you're just going to have to wait. You might have to wait a few days. You might have to wait a week. You might have to wait 2 weeks for there to be another zone. But this is the thing. We trade everything. We trade indices. We trade gold. We trade energies. We trade absolutely everything. So it's really not a problem if on one specific asset, we can't find a trade for a while. So let's do a little practice. We can see that we just open up the chart. Let's assume that we're looking for demand. What we're going to do, we're going to look below to the left. Do we see an impulsive candle? Here, yes, we see an impulsive candle. Below, do we see an indecisive candle? Yes, we see an indecisive candle. Above, do we see an impulsive candle? Yes, we do. Cool. So just like that, we've identified an area of demand. We then go ahead, we mark out the lowest wick to the highest wick, or if we want to do the preferred, we can do the body. In this case, let's just do the wider. So now let's play out price. Cool. So we can see that price is now just tapped in, and we had a reaction from there. And we can see that price is tapped in a second time. And once again, we had a reaction from there. Okay. But now this begs the question of, cool, how is this zone still valid? And the only way that we can check that is if price has retraced into this level more than 30%. Now, how can you check that? Sorry about that. How can you check that? Cool. So what you can do is you want to go over to this measurement tool. Now, with this measurement tool, you're going to go from the bottom line to the top line, just like so. Cool. And we can see that you want to focus on this number right here, 64.8. We then go ahead, put a line on the wick, just like so. And then we want to go back to this measurement tool. And then we go ahead, sorry, not from down, you need to go from up, like so. Just like this. Cool. And then 19, 20, 20. Cool. So now is 20 30% of, I believe it was 68.4. Let me just double check. Okay, so in this case, I believe it was 68.4 the entire zone. Let's see, let's check. Okay. I think I did that a little bit. There we go. Go exactly on the line, just like so. Go to the top, on the line, 65.4. Cool. So technically, this is pretty much exactly on the dot, 30% retracement into this zone. Okay. And then this one here, we can assume is slightly less. So right here, we're really on the edge, right? Because 30% is the hard cutoff. And I believe that 30% is exactly what this is right here. Okay, so we can still technically trade this zone, but it's very, very close. So let's see what happens. See if this zone is still respected. Okay, cool. We've now tapped into this zone. Okay, looks like we're getting a nice reaction from it. Cool. So we got a nice reaction from it. So we could have caught this trade right here. However, what we can see now is that when price tapped into this level, it has gone significantly past the 30%. So what does that now mean? This zone is no longer valid, okay? This zone is no longer valid. We no longer care about it. It's like it didn't exist, okay? So, yeah. And as we can see, that is why the rule is very important, right? If we weren't paying attention to that, we might have thought, cool, we can get another trade out of this. And then we would have placed an order here and we would have got absolutely fucked. So yeah, very, very important. It's probably, no, it is the most important rule. Okay, cool. So let's talk about ZOZ or zone over zone. So what happens if you're in a situation where you have a zone over a zone? So you have a zone in the same proximity as another zone. Sometimes they'll be overlapping, sometimes they'll be right next to each other, and sometimes, they will be quite far away from each other. Now, in this example, we can see right here, we have this zone, which is going to be a drop base rally, and then we have a rally base rally. So in this case, we can see that we have two zones above each other. This one right here, so the lowest zone is going to be considered the original, and the one above will just be the zone over zone. So in this situation, you essentially have three options. Now, the first thing that you can do is you can wait until price comes to the original zone. Now, the cons of this is that you have a lower chance of getting filled. Why? Because price could tap into this zone and then move away without you, meaning that you have not been entered into this trade. The pros of it is, of course, you'll get a very nice RR. If we was targeting the previous highs, then we can get almost a 7 RR. Now, option number two is that we're going to go ahead and include both zones. Me personally, I just don't like doing this for a few different reasons. As you can see, first one, you get a lower RR. And because your position is just so much bigger, like you can spend an eternity in drawdown. And yeah, this is just not my favorite option, to be honest with you. But you do have the highest chance of getting filled, right? So yeah. Option number three, this is the one that I usually do. So I'll take the first zone. And the cons, if for whatever reason price is drawing to the original zone and I get taken out here, well, then that's fine because I can just give it another attempt, right, at this original zone. And because we're targeting a big RR, the loss from this position will be made up from this position with profits. So, yeah. Okay, so let's talk about each option and when it is the best to use them. Now, over time, you'll build up your own judgment on when to use them, but this is kind of the best guidelines for you to, I guess, go into the market, backtest, and yeah, just have an understanding of when you can use each option. So, option number one, right, targeting the original zone. Now, this makes sense when we have two zones which are overlapping each other. So, in this example, which I hope you can make out what I'm trying to do here, but we have two zones which are basically intertwined, overlapping each other. Now, in this case, it makes sense to use the original zone because we can assume that the original zone, so the zone at the bottom, was what actually caused the move. So that's the origin of the move. So we can assume that this is the institutional activity and it has entered here essentially, or institution has entered here. And then the secondary zone was just a little bit of a continuation, right? So if you have two zones overlapping with each other, then you can target the original zone. Option number two, now this only ever makes sense if you have two zones which are pretty much right on top of each other and the two zones in size does not make your stop loss like ridiculously big, as we spoke about. Okay, because if it makes it ridiculously big, you might as well either rely on option one or option three. Now, option three for me, this is what I would say is best practice and what I do the most. So in this case, usually we'll be using it when we have two zones on top of each other. However, they're not super close, like they're not close in proximity. So in this case here, we can see that we have one zone and a little bit below we have a secondary zone. In this case, using option number two just simply doesn't really make sense because once again, our stop loss is going to be absolutely huge. And then the risk with using option number one is that, well, price could come into this first zone and then move away without us. Now, with this, there is a risk that, okay, cool, this first zone is not respected and it could be drawing to the original zone, right, the origin of the move. However, if that is the case and we get stop loss on this first attempt, as I said, we can just target the original zone, and because our RR will be greater, we'll make up our losses. So yeah, go ahead, take a screenshot of this, backtest it, and get an understanding of it. Okay, so let's talk about fundamentals. If you're familiar with trading, you will know what fundamentals is. If you're not, that's fine. I'm going to explain it to you right now, and then how we actually use fundamentals in swing trading, because it's a very, very big part. So fundamentals is what really drives price. All of these candles that we're seeing in front of us, they don't just appear. right? Behind the candles, there is people buying and selling, and people buy and sell when certain things are happening in the world. So for an example, right now, as I'm recording this, there's a conflict between Iran, the USA, and Israel. So how will that affect the market? Well, specifically, we can expect gold to go up. Why? Because there is fear right now in the US economy. Perhaps Iran will strike back, etc. And because of that, they want to essentially make themselves safe by investing in gold, which is a real world asset, a tangible asset. Okay. So that is one example of fundamentals. Now, the fundamental tool that we use is the COT data. It's the Commitment of Traders report. I'm going to bring up the website after this. But essentially, what it allows us to do is see within the market where the big money is betting or whether they are buying or selling. Okay, so I'll get up the website now. So here we are on the CFTC website. This is a government agency in America, and legally all of the biggest hedge funds, all of the biggest brokers that get orders coming through their platform from institutional money, also, just regular retail traders, they have to report on a weekly basis legally to this website. Now, when you come onto this website, the place that you want to go is to forms and no, where is it? Here we go, yeah. Under here, Commitment of Traders report. This is what we're really interested in. Now, underneath this, you're going to see a bunch of different markets. We have here agriculture being like wheat, soybeans, etc. Then we have electricity, gas, everything that you can imagine is here. Financial, this is specifically the currencies, which is really helpful if we're going to be trading Forex. We have Coinbase even, we can look at crypto. Okay, cool. So when you go onto this report, it's going to look a little bit overwhelming at first, but don't worry, you have a tool that you can use, which I'll show you in a second, which basically consolidates all of the data, makes it really, really simple for us. But when you go into these reports, you're going to see two categories. You're going to see commercial and non-commercial. Commercial, think big money, okay? Big institutional money, hedge funds, etc. Okay? Why is it important that we follow these people or use them in our trading, right? It's because they have tons of more resources than us. They are dealing with billions of dollars, right? These are real professionals that have billions and billions of dollars on the line. So if they have much more resources than us, then it makes sense to use them within our trading to get an understanding of how we should be trading, what markets we should be trading, etc. Non-commercial is your retail traders, okay? So yeah, it's very confusing when you first come onto here, but don't worry. As I said, we have a tool that we can use, but yeah, we literally have everything here. So for an example, Canadian dollar right now, institutional money is more short than long. Then we have Swiss franc, they are more long than short. And we literally have everything here, have like even cattle and lumber, literally anything that can be traded. So yeah. But anyway, we don't actually need to look at this. Luckily, there is a tool that we can use, which makes this a lot more easier to actually. So you're going to come over to Trading View. You go to Indicators. As you can see, I have it saved, but you can just go ahead and search up COT. And then it's going to come up here. It's by this guy, Noldo. Shout out you. Go ahead and click on that. And then you're going to have a chart which appears. So the green line is representing commercials, big money. The red line is representing retail traders, so everyday people who are participating in the market. Anyway, so as we can see now, let's just take a look at a few different examples. So let's take a look at the US 30. So right now we can see that the commercials are actually slightly bearish on US 30. And if we take a look at the S&P 500, we can see that they're actually very bullish on the S&P 500, okay, which is interesting. So if we see that in this case, the S&P 500, the commercials, the big money is betting that it's going to go up, well then if they're betting that it's going to go up and we can find the technicals which align with that, so we can find a demand zone to take a trade off, well then we have a really good trade. Our technicals have aligned, and also the fundamentals say that it's going to move higher. So that is a little insight into how we actually use this. But obviously, I'll give you more of an explanation So yeah. Okay, so how do we actually use the COT data? I'm going to give you a live example. We'll go through it together. However, to make it really simple, what we are doing is we're essentially using the COT data as almost like a magnifying glass or like a sniper, right? We look through all of the different markets and we see, okay, cool. This market is very bearish on the COT data. What does that mean? If it's bearish on the COT data, the fundamentals, the technicals, which we went over, being weekly trend, finding those supply zones on the daily, right, have to align. So in this case right here, we can see that, okay, cool. On ES, S&P 500, very, very bullish on the COT data right now. However, we can see that if we go to the weekly, it's not really the best price action, as you can see, right? Yes, overall, we are going up. However, in the recent weeks, we've definitely been trending more to the downside. So in this case right here, the fundamentals and the technicals do not really align. Because if they were aligning, then when we go onto the weekly time frame, we should see a clear uptrend. And then when we go onto the daily, we should be able to find that area of demand. In this case, the fundamentals, yes, they are bullish. However, when we go to the weekly time frame, when we start looking at our technicals, they are not aligned with the fundamentals, meaning that they are not clearly bullish. Okay. And that is essentially how we use the COT data. We scour through the different markets and we see, okay, cool. The commercials are bullish on this specific market. Now let's look at our technicals to see if it is also bullish, if it is also aligned. Now, once you go through all of the markets and let's say you see the COT data, very, very bullish. You see that the technicals, very, very bullish. So they are aligned and you can see, okay, cool. There's a demand zone here. Going to take a trade of that. You have a perfect trade. Very, very high probability. Very, very good trade. And as I said, if we are in a situation just like this, where the fundamentals are pointing one way and the technicals are pointing another way, well, then we have not got alignment between the fundamentals and the technicals. And that is a market that you want to avoid. Now, following this strict structure, what it will do is it will limit you to the amount of trades that you are taking. However, it will improve your overall quality of the setups that you are taking. So yes, on one specific market, you might only take maybe 1-2 trades a year. However, what you need to remember is there is like 30 different markets that we can look at. So let's say we take 1 or 2 trades on S&P 500 and we take 3 on US 30, 4 on NASDAQ. Then we have all of the different currencies. We take 7 between all of the different Forex pairs, 5 between the commodities, So my point is that yes, you're not going to be taking frequent trades on the same market because we are waiting for this alignment. However, your overall probability will be very, very high. Okay, so now let's piece everything together. So what's the first thing we're going to do? The first thing we're going to do is we're always going to refer to the COT data. As I said, the COT data is like your sniper. It's like your magnifying glass. It's how you identify the best markets to trade in. So we want to go through different markets, right? Whether it be metals, indices, energies, currencies. And we essentially want to see where the COT, specifically the big money, the commercials, are either significantly bullish or significantly bearish. Now, once we have identified a market where we can see, okay, cool, the big money is really, really bearish here, we then want to rely on the technicals to see if they align, right? One more time, what's the difference between the fundamentals and the technicals? The fundamentals is what drives price. The fundamentals is what we're using right now. And the technicals is what we've been learning with the formations, weekly market structure, etc. So step 1, identify good market with COT data. Once we have identified where we are either really bullish or bearish, we then rely on the technicals to see if it aligns. So for an example, right here, on Swiss franc, we can see that currently, if I get it up, we are very, very bullish on the COT data. Now, the next step, are we also bullish on the overall technicals, being the weekly trend, and also can we find an area of demand to potentially take a trade from? So on the weekly, we can see, yes, we're extremely bullish. Cool. That's a good sign. That's step 1. Now, step 2, we're going to go over to the daily. Now on the daily, what are we doing here? Well, the daily is used for execution. It's used for actually finding our trades. So here, what we'd be looking for is we would be looking for an area of demand. How do we find demand? Well, we look below, and as you can see, we actually have a bullish candle right here. Sometimes you're not going to have to like look, really far to try and locate it. It might be right in front of you. So in this case, we can see that we have our leg out right in front of us. Now we look below to the left. Indecisive, 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 indecisive. Now above to the left, impulsive candle. Cool. So this right here is going to be our base. Now remember what I said. We do not just need one candle, two candles, three candles. It can be an accumulation of candles. And in this case, it is. So what we're going to go ahead and do is we're going to go ahead and mark out our base, isolating those indecisive candles. Now, let's go ahead and just for best practice, mark this out so we know what we're really looking at. Cool, so we are marking out these indecisive candles. Brilliant. Now, in this case right here, we can see that the wider is very, very big, okay, which means that we would not get a good RR. And also price has not traveled a far distance from here. Now, in this case, let me just get rid of this shit for a second. Cool. Price has not traveled a far distance from this level yet. And remember what we spoke about right in the beginning, I believe, about how we want to see momentum follow through from here. Okay. We want to see a move from here continue. And if we were to just tap back in here, well, that wouldn't really be a valid trade. Why? Because we haven't seen a nice momentum. We haven't seen a nice push from this area. So in this case, it wouldn't even make sense to target the wider because we have not seen a big enough push from that area. So we can go ahead and mark out the preferred. We're looking at demand. Bottom line stays the exact same. Top line, we move down to the highest candle body within the base. Remember, the base is the indecisive candles. And in this case, from what we have isolated, this candle body right here, this white one, is going to be the highest candle body. Cool. So now we've isolated that. What do we have? Well, we have the COT being very bullish. We have the technicals being very bullish. And on the daily, we have found an area of demand where price could potentially tap into. So overall, what we have here is really, really, really good trade that we could potentially look to take. Now, because we are trading Forex, most of the time, most of you guys, you're not going to be able to just trade the Swiss franc futures alone because a lot of you will be trading with prop firms, etc. So what does that mean for us? Well, we need to trade the Swiss franc pairs. So how do we actually go ahead and do that? And this applies for every single pair and currency. The process stays the exact same. 2 seconds, let me just organize. Cool. So when trading Forex, some of you might not be familiar. What is the foreign exchange market? It's currency versus currency. And when we are trading the pairs, we are trading either one currency being strong and the other being weak or vice versa. Now, in this case, we can see that the Swiss franc is strong, the fundamentals align, the technicals align, everything is looking absolutely perfect. So what we would then be looking to trade is a Swiss franc pair. Now, the most common one is going to be USD CHF. We also have a few other ones, but for this example, we're going to use USD CHF. Let's go back to the Swiss franc. Cool. So fundamentals, technicals, everything is aligning on the Swiss franc. That's absolutely great. So now we need to scan through and see if there is any other currencies which are weaker than Swiss franc. So the exact same process applies. We're going to go to the different currencies. We're going to see, okay, cool. Fundamentally, which one is weaker with the COT data than Swiss franc? Once we have identified that, we then look further into the technicals to see if they are aligning, okay? Remember, fundamentals, then technicals. That's the way that you have to do it. So, in this case, let's go ahead and take a look at the dollar. So, dollar, I'm going to go to the weekly. Let's go ahead and get up the COT. Now, the COT, as we can see on the dollar, it is not extremely bearish by any means. However, we can see that it's significantly weaker than the Swiss franc if it wants to load. So as I was saying, in comparison to the Swiss franc, we can see that the dollar is currently looking much weaker in comparison. If we take a look, COT here, extremely bullish, COT over here, not bullish. And also we can see that the technicals being the weekly, we're looking at overall direction is bearish. You can see that we have a high, lower high. This looks like it's about to form a lower high. So yeah, so based off that analysis, we know that fundamentally speaking and the technicals, Swiss franc projected to move higher, dollar projected to move weaker. So USD CHF, theoretically, there should be a good trade. So now we come over here and we identify leg out, impulsive, indecisive, indecisive, indecisive. And we can see that potentially there could be a short position coming off here. And because it's USD, CHF being the dollar versus Swiss franc, we're going to be looking to short because, as I just explained, we're looking for Swiss franc to be strong and the dollar to be weak. Now, this example that I just showed you is not isolated to just, of course, USD, CHF. The process remains the same. If we was looking at Euro, for an example, and we take a look at the COT data, we can see, okay, cool, extremely bearish. Do the technicals align? Well, no, we can see that we're actually very bullish on the technicals. So this is not a market that I want to participate in right now. And then I go through them until I find a market where the technicals are aligning with the fundamentals, and that is a market that I would like to trade. The only extra step with Forex, because we are trading currency versus currency, instead of just finding a market where we see, okay, COT, bullish, technicals, bullish, we then need to find another currency, which is doing the opposite in order to trade that pair and look for a trade. Okay, so now let's go through an actual example of how you would apply this to the market. Also, you can see here on the euro that the COT data is currently bearish. The market structure is also bearish. Now, if we go over to the dollar, what we can see is that the COT data is bullish and the market structure, we can see that it's also being bullish. So that is exactly what we're looking for. We're looking at the fundamentals, dollar bullish. With that, the technicals align being also bullish. And then on the euro, it's the opposite. COT data is bearish. And we can also see that the technicals are aligning with that. So from that analysis, we can expect that the euro is going to be weak and the dollar is going to continue strong. So now we go over to euro USD and look for a potential entry. So now we're over on Euro USD, and as we're looking that the euro is going to be weak and the dollar is going to be strong, we're going to be looking for shorts, which means that we'll be looking for supply on the daily time frame. So how do we find that? We're going to go ahead and look above to the left. Do we see an impulsive candle here? No, we don't. I already have it marked out, to be fair, but we can see here we have an impulsive candle, indecisive candle, the other side of that, impulsive candle. Cool. So we've now just found our area of supply. From here, we're going to go ahead and mark out our position just like that. And we can add a limit order. So for those of you who aren't familiar, limit order is basically just a pending order. You can do it on like pretty much any platform. And essentially, this just means that instead of having to manually enter, when price comes up to this level, it will automatically put you into the chart. This plays out, we can see price tapped in and then proceeded to go short. So we would have hit TP. And just to simplify it, if we're looking at a market, for an example, DAX, which is an indice, then we don't need to do any other like cross currency analysis or anything like that. That is purely just for the Forex because we're looking at one being strong and the other being weak. With this, we simply go through all of the different indices and we'll just see, okay, cool, the COT data is bullish or bearish. We look if the technicals are going to align, and then from there, if they have, we can take the trade. So some final key points that I want to leave you guys with. So you need to add 30% to your stop loss, right? So let's say, for an example, we have our base being like this. So our entry is going to be here. Now, instead of just putting your stop loss, that's the wrong position. Never mind. There we go. All right, cool. So instead of just putting your stop loss at the bottom line, instead what you want to do is add 30% of this, the size of your base. And the way that you can measure that is the exact same method that I showed you with the freshness tool. Measure how much this is, figure out what is 30% of that, and then you can just go ahead and mark out 30% like this. The only difference is it will say minus. And then you know that, okay, cool, that's 30%. I want to go ahead and put my stop loss just like that. Very, very important stuff. Very, very important stuff. Now, this is one thing I told you we was going to go back to the anticipatory breakout and the consolidation. Trade management dependent on the trend. So start with the easiest two, which is what we've really been focusing on. In an uptrend, of course, we're looking for longs. You want to aim for a 1, 2, 3. So whatever you're risking, you should get 3x at your TP. Now, you want to go break even, which means moving your stop loss to your entry at a 1 to 2. That is when we're following the trend. That is when we're trading with the trend, okay? Same for downtrend, just the exact same, but opposite, obviously short, aim for a 1 to 3, go break even at a 1 to 2. Now, anticipatory / breakout. Remember, I showed you a few examples of a breakout. Now, these ones are really interesting because usually if we are correct and price is breaking out in that direction, we can catch big RR. Your fixed risk to reward should be a 1 to 4. However, like you can really, really milk these. Like if you want to let it run, you'll be amazed. Like you can genuinely, absolutely milk them. However, what that comes with, our kind of risk protocol, is that we want to go break even at a 1 to 1. Why is that? Because usually when we're breaking out, if we're right, we're gonna see indications that we're right straight away. Like it's just gonna fucking launch, right? And if it doesn't do that, then probably it's not it's not the right trade to be in. So we might as well protect our capital a little bit faster by putting our break even at a 1 to 1. Now, consolidation, honestly, whilst you're first trading the strategy, I don't recommend trading consolidation just because there's a lot of discretion involved. Discretion meaning market experience, and honestly, you're just better off following the trend and anticipatory / breakouts. That is what you're best off doing. However, once you've built more of an edge, more discretion with this strategy, you can take trades in a consolidation. However, we only want to aim for a 1 to 2 because when we're in a consolidation, the moves aren't big and you want to go break even at a 1 to 1. So yeah. Alright guys, that's going to be the end of the video. I genuinely hope that you got some value from this video, from this course. Now, next steps from here, go ahead and backtest it, collect data on it, and once you see that you're consistently profitable over a long enough time frame, then get into the markets and start. Now I have just opened a few more spots to my academy. Like, you don't need it, you can literally learn from this video and go and test it for yourself. However, if you are interested, you can check that out down below. Last time I opened a few spots, it went like that. I decided to open a few spots again, let a couple people in. We do live calls, I show you what I'm trading, etc., all that good stuff. You can go ahead and check that out. But yeah, let me know what you think about these educational type videos. I want to continue doing them, not just showing like my everyday life, etc. I feel like that gets a little bit boring. But genuinely, your feedback on this video would be very much appreciated, and let me know what other kind of educational videos you want me to do. But if you made it to the end, I appreciate you. Like, subscribe, all that good stuff. See you in the next